Hey everyone, welcome back to Resonanz Spotlight Strategy Notes. I'm Vincent.
And I am Saâd.
In this mini-series, we take one investment idea at a time and break it down for professional investors. What matters, what doesn't, and where the risks really are.
Today's topic is catastrophe bonds or cat bonds.
And the real question for us is not what cat bonds are, it's whether they actually deliver diversification when portfolios need it most, and whether allocators fully understand the trade-offs they are making.
At a very simple level, a cat bond is insurance risk turned into bond. Instead of an insurance company carrying all the risk of a hurricane or an earthquake, investors take on part of that risk and get paid for it.
You earn a floating coupon, usually cash rates plus a spread. But there's a clear condition. If a predefined catastrophe happens, some or all of your principal can be used to pay insurance claims.
Structurally, these bonds are issued through a special purpose vehicle. The collateral is ring-fenced, so you're not taking balance sheet risk from the insurer. You're taking event risk.
And that's what makes them interesting. Returns don't depend on growth, inflation, central banks, or earnings. They depend on whether a hurricane hits Florida or an earthquake hits Japan.
Triggers matter a lot. Some bonds are based actual insurance losses. Others are parametric, for example, wind speed or earthquake magnitude.
And there's always a trade-off. Indemnity triggers are closer to real losses, but slower and more complex. Parametric triggers are faster, but introduce basis risk.
So why are professional investors paying more attention now? First, diversification. Cat bonds returns have historically shown very low correlation to equities and traditional credit.
Second, carry. You get cash rates plus a risk premium. And in a higher rate world, that base carry actually matters again.
And third, pricing cycles. After years with heavy catastrophe losses, reinsurance markets tend to harden. That usually means spreads and better forward-looking returns.
I agree. But I add one caveat. Diversification only works if investors are honest about what kind of risk they are taking.
Meaning,
Yeah, the drawdowns don't look like equity drawdowns, but they can still be sharp, sudden, and uncomfortable, especially when several events cluster in one season.
that's true. Cat bonds don't fail slowly. They fail quickly and then recover slowly.
The biggest risk, in my view, is psychological. You can earn steady carry for several years, and then one hurricane season gives back a large part of it. And that's often when investment committees start asking tough questions.
Model risk is another one. Catastrophe models rely on historical data, but climate patterns are changing. Managers need to explain how they adjust for that, not just rely on a model output.
Liquidity is also not guaranteed. Around peak event periods, secondary market can dry up, and NAVs can gap lower even before losses are fully known.
And governance really matters. Collateral quality, trigger definitions, reporting transparency, these things sound boring, but they make a huge difference when something goes wrong.
So, how should allocators approach this in practice? A simple rule of thumb: size the allocation small enough that the bad catastrophe season doesn't force you to sell.
Many start with 2 to 5% of an alternative sleeve, and they diversify heavily across perils, regions, and sponsors.
Another important point: don't treat cat bonds like credit. They behave differently, especially under stress.
And don't over concentrate in US hurricane risk just because spreads look attractive. Diversification within the strategy is just as important as diversification versus other assets.
So, if there's one takeaway, it's this: cat bonds can diversify portfolios, but only if investors accept that nature, not markets, drives the risk.
They're not a free lunch. But for allocators who understand the mechanics and psychology, they can play a very specific and useful role.
And that's it for today's episode of Resonanz Spotlight Strategy Notes. Short, focused conversations on the forces shaping investment strategies.
Thanks for listening, and we'll see you next time.